So are you a good lender? Because most people think they are. But there's going to be a few differences between those who succeed and those who fail in this arena. So if you watch this video to the end, you're going to learn how to discern a good deal from a bad one, how to pull the trigger on a great deal rather than slowing your growth due to analysis by paralysis. So I'm going to lay it out, and it starts here. So number one, as a lender, you have to be good at clearly communicating your loan terms. And did you hear me? Your loan terms. Because if you're the lender, you control the deal because it's the money that controls the terms. So you got to make sure you clearly communicate the terms of the loan to the borrower, including the interest rate, the repayment schedule, and any of the fees and penalties. And I'm going to preface penalties. If they pay late, there's a late fee. All these penalties need to be clearly outlined because this is going to help the borrower understand their obligations and avoid any miscommunications or misunderstandings along the way. See, we call this the note, right? The promissory note. It spells out all the terms. Who's the one that determines those terms? Is it you or is it the borrower? Now, I think some private lenders have this backwards. They think the borrower determines the terms. Wrong. They have the opportunity, but you have the money. And the person with the gold makes the rules. I might have said that a little bit wrong, but you've heard that before. So you set the rules. What interest rate do you want on your money? You want to be in a first position? What is the security you require? What are the terms that you're willing to go out? Is it 12 months, 18 months, 24 months? What do you want? If they pay the deal off too early and it cuts into the amount of interest you're going to earn, is there a prepayment penalty? Do you see what I'm saying? So as the private lender, you gotta articulate all of this. It's one thing to have the note and all that's in the note, but you really should point out the key points of your terms to every borrower so that there is no miscommunication. Hey, Mr. Borrower, if you are late on this payment, you're going to owe me $50 per payment that's late. That's our late fee. It's right here. Okay? If you don't pay me off on the stated date that this note matures, you have another 3 months to pay me in full because this note balloons. And if you don't, we're going to proceed to a foreclosure proceeding. I just want to make sure you understand that. And I could go on, but again, this communication really comes down to you because they're your terms, therefore you need to explain them to the borrower. The second thing, you want to be fair and you want to be transparent. So be fair in your lending practices and be transparent about your fees and charges. This is the one thing I find is kind of hidden sometimes. I think sometimes private lenders will throw in points, but they don't want to tell the borrower, they don't want the borrower to really get hung up on it. Be upfront about it. Be transparent. Be like, hey, I charge 3 points upfront and 12% interest. And my term is 12 months. Are you okay with this? So being transparent, putting that right front and center will help that relationship because now they don't think you're trying to hide something from them. And later, if there are problems, you can basically always point out, we discussed this. This is going to help you build trust with borrowers. And it's going to make them more likely want to do business with you again and again in the future. Now, let me just give you a personal story. I've borrowed money from lots of people. I might even be safe to say probably hundreds of people that I borrowed money for or from during my entire real estate career. And we flipped hundreds and hundreds of houses. And I remember some of the lenders that I borrowed money from, they weren't transparent. I got into the deal and then they would change the deal or things wouldn't be what they seemed to be. Now, maybe I missed something. I didn't read every little detail in the note, but these things weren't explained. And it always came down to the draws. If I borrowed money, a lot of times the lender that I was borrowing from would basically give me all the rehab money, but it was usually in the sake of draws. And I would have to do X amount of work to get that draw. Now, here's where I fell into hard times, and this is where I really didn't like the lender's way of doing business because I spelled out all the work that I was going to do before I got that first draw. So I would get the work done, they would send their inspector out, and then I would be waiting, and then nothing. And I called them up and I said, hey, listen, we submitted the draw request. We did all the work. Your inspector came out. Like, what happened? And they said, yeah, about that. In there, when you did the renovation budget and you gave us the work that was going to be done, it said this. And I said, yeah, and we did that. Your inspector saw that. And he says, yes, but he said this part wasn't done. And I think it was, just give you an example, like, roof is going to get done. And when the inspector came out, the gutters weren't done, but the gutters were thrown in with the roof. So they wouldn't give me the draw, which means I front loaded all the money for that roof, but because the gutters weren't on there, the lender used that as a reason not to advance that draw. Now that is someone not being transparent. And it also put me in a tough place, making it so I didn't want to borrow from them ever again. And I didn't. I found somebody else that was more transparent. Number 3, this one I struggle with a little bit, but you got to be flexible. Private lending can be a flexible option for borrowers. Be considerate when you're negotiating the terms, because even though you have the money and you set the terms, there is also some negotiation that can happen. And that negotiation can come in a lot of different ways. So I just urge you to be flexible with the options for borrowers. Give them a couple different options, lay it out, make sure it's within your parameters as the lender, but also you got to somehow, there's a fine line, and you got to kind of come in the middle of that line. So the borrower has specific needs and you have specific needs as a lender. So there's a happy medium in the middle, but that sometimes will take negotiations to get there. But sometimes you might have to meet in the middle, if you know what I mean. That leads me to the next one. Number 4, consider the borrower's ability to repay. This is on you. So this is part of the due diligence, the underwriting process. Can the borrower repay you? So if things go sideways with the deal, it's really important that you consider the borrower's ability to repay this loan before you ever loan the money to them. Because if you didn't look at their personal financial statement, if you didn't look at their assets and their income, shame on you. They might have all the intention to pay you your money, but if something doesn't go right with the deal and they have no money on the back end to make good on the payments, what are they going to do? They're going to default. So that was really something you should have done the due diligence on yourself. And I think this is an area where a lot of private lenders really fall short. Either they don't do the due diligence, they take everything that the borrower says, as the gospel, and they don't really look behind the curtain. But the first thing I'm asking for is, show me your personal financial statement. How many assets? What are your assets? How much money do you got? You got a 401k? What's your income? How many income sources do you have? If this deal can't be flipped, if you can't sell it, what's plan B? Okay, what if you can't do that? What's plan C? What if the bank won't lend money? What's your plan after that? So they might not have an answer for all of them, but I want to know what their thought process is. I don't want them to sit there and say, oh, well, no, it's definitely going to sell. And what if it doesn't? If somebody says that to me, if a borrower says that, well, it's definitely going to sell, I'm going to call their bluff. And I'm going to always say, and when it doesn't, what's your plan? And if they don't have one, I'm not going to lend to them. So the borrower's ability to repay the loan is very important to me. And it should be really important to you before you ever lend to them. So be sure you review their credit history, because if they got bad credit, that means they haven't fulfilled on other obligations. Not only that, review their business plan, review their deal, review their personal financial statements, and make sure that there's the statements that go along with what they put in the personal financial statement. All the supporting documents are there. And then determine what the risk level is with this particular borrower. Some borrowers are much higher risk than others. Forget about the deal for a second. I'm just talking about the person, the borrower itself. That's the first part. Now, number 5 is have a plan for default. So it's important to you that you have a plan in place, and you should articulate this plan to the borrower. I like doing this. So I basically say, hey, in the event of a default, if you stop paying me and you stop communicating with me, here's how the default works. And explain that to them. Because this is the point where you're going to make it crystal clear that if they don't pay you, you're taking the property. And this is going to include working with the borrower to come up with a plan to get them back on track. So you might say, all right, here's the plan. First thing we're going to do, we're going to work with you and we're going to communicate with you. But if you stop communicating, it's all bets off. We're just going to foreclose. But we're going to work with you to come up with a plan on how to get you back on track. And if they don't communicate or they don't want to work with you, well, explain the legal action and how this will work to recover funds. Not just taking the property, because they might say, fine, just take the property. Say, no. We're not going to just take the property. I'm also going to sue you. I'm going to sue you for legal costs. I'm going to sue you for all the back interest. I'm going to sue you for the interest on the interest during the time it takes for you to pay me. And I'm going to sue you for the late fees. So explain that. Now, I know that sounds really bad, and maybe you can make me out as a bad person, but I've just done this a lot. And the more upfront you are in the beginning about this process and this plan for default, the better off you're going to be, because now you've set the expectation for worst case scenario. And I can tell you that borrower doesn't want to go down that path. So you having a plan for default, articulating and being transparent about that plan for default, maybe even putting it in the note or giving them an addendum to the note saying, hey, this is what happens if things go sideways. Number 6, you always have to protect your investment. So as a private lender, you are investing your own money. So it's really important to protect that investment. This may include requiring collateral, or even sometimes having it cross-collateralized in addition to the collateral. If the collateral is not enough to support your loan, you might ask them to cross-collateralize it with another property. So that right there requires them sometimes to do a personal guarantee. I love making borrowers personally guarantee the loans because, let's look at it this way. Why would I ask for a personal guarantee? Because the property that I'm lending on and the entity that I'm lending to, because I never lend to individuals, I only lend to an entity. That property might be the only thing that entity has. So for the borrower looks at it and says, hey, listen, I can just walk away from this property, walk away from the entity, and that's the entity, and that's the only thing I lose. And if the borrower doesn't have much skin in the game, well, then they walk away without much lost. But if they personally guarantee that deal, now as the lender, I've got the property inside the entity. I got whatever assets the entity has, but now I've also got a personal guarantee from the borrower. And once you get that personal guarantee from the borrower, they're on the hook. And you got to help them understand what that means. That means that if you default on this and you don't pay me, I'm not going to just take the property. I'm going to come after all those personal assets that you gave me on that personal financial statement. And I'm gonna go after those until I'm made whole. Listen, don't make me out to be a bad guy. Don't make any private lender out to be a bad person. Because this is exactly what a bank does, right? You ever default on a bank? That's exactly what they do. So all you're doing by being a private lender is you're being your own bank. So please act like a bank. Mimic a bank. Do what a bank does. So let's do a recap real quick, because these are all the things that a bank does. Number 1, clearly communicate your loan terms. Make sure that they're understood. Make sure the borrower understands the obligations and avoid any miscommunications in the future. Number 2, be fair and transparent. Be fair in your lending practices. Tell them about the fees and the points and anything else. You always want to make sure that stuff's right out front and center. Number 3, you got to be a little bit flexible. So private lending can be flexible. You can give them options. You can negotiate the terms for what you set. And number 4, consider the borrower's ability to repay. It's really, really important for you to consider this, because if the borrower can't repay the loan, if the deal goes south, well, then that's your fault because you didn't do your due diligence. You didn't look at the credit history, business plans. You didn't look at the deal, the personal financial statements, and you didn't determine the risk level. Because if they were a high risk, you shouldn't lend to them anyway. Number 5, have a plan for default and explain that plan for default to the borrower so they understand the legal actions they will have to take and go through to recover the funds that you lent them. And number 6, always, always, always protect your investment. As a private lender, you are the bank and it is your money. So please do what a regular bank does and protect those investments. Make sure that you're secured in first lien position. Make sure everything's done the proper way. Get a good attorney that will help guide you through this. These are some great tips if you're going to become a private lender. And these are some tips that you need to apply in your life. So folks, I hope you enjoyed this. I hope you got something out of this. And if you did, check this video out. Where should I use my infinite banking policy? Thanks for joining me. See you on the next one.